In this video, you'll learn how to place a stop-loss order on the Robinhood platform, straight to the point and without wasting time. I'll show you 2 ways to place a stop-loss order within the application. To begin, we need to open the application. Once inside, you'll see a view like this. Let's say you have a profitable position or you simply want to limit your losses. In that case, what you need is to set a stop-loss order. In this example, I'm going to use a TSL24 put option. I enter the position, and as you can see, my average price is 1.45, which means I'm already in profit. My goal now is to secure those profits, regardless of what happens to the price. I click on Trade, then on Sell, and select how many contracts I want to sell. In this case, I have 2, so I choose both. If you had more contracts, you could sell only a portion. It all depends on your strategy. Currently, the bid price is around 1.67, and I entered at 1.45, so I'm in the green. First, I'm going to click where it says Limit Order, because there are 2 main ways to use a stop loss. The first is the stop limit. In a stop limit, you have 2 key prices. One is the stop price, or activation price, and the other is the limit price, or minimum selling price. For example, if this option moves between 1.72 and 1.79, and I want the stop to be triggered when it reaches 1.60, I set that value as the stop price. That means that when the price touches 1.60, a sell order will be sent. But be aware, it won't automatically sell at 1.60. That's where the limit price comes in, which is the minimum price at which you're willing to sell. If you set the limit price to 1.60, the order will only be executed if someone buys at that price. Sometimes it's a good idea to place it a little lower, for example, 1.58 or 1.59, to increase the likelihood of it being executed. Something important. If the price drops very quickly and goes directly from 1.60 to 1.40, the order won't be executed. The market doesn't move linearly, and you need to understand that. You can also use a more advanced strategy. Set the stop loss to trigger at 1.60, but place the limit price higher, for example, at 1.70. In that case, if the price falls to 1.60 and then bounces back, you would sell at 1.70 or higher, although there's no guarantee that this bounce will occur. I'm not going to send it now because the price is very close, and I want to show you the other option. Now let's look at the classic stop loss order, which is the second way to place a stop loss, and which appears as a stop market order on Robinhood. This type of order works like this. When the price reaches the level you define, a market order is executed, meaning you sell at the best available price at that moment. Robinhood even shows you an explanatory chart. The price drops, then the stop loss is triggered, and the order is executed immediately. The downside is that you might not sell at the best possible price, but the advantage is that the order is almost always executed, which is key if you absolutely need to exit the position. Therefore, this method is less risky for exiting a trade, although you might earn slightly less. In this case, the bid is at 1.58 and the ask is at 1.67. I entered at 1.45, so if I place the stop loss at 1.50, I would be securing $15 profit per contract. I simply enter the trigger price, review the order, and swipe to confirm. From that moment on, if the price reaches that level, the sale is executed automatically. A good practice is the following. When you enter a position that moves in your favor, place a stop loss and gradually raise it as the price moves. In Robinhood, you can do this by accessing the option, going to the history, tapping the confirmed order, and selecting Replace Order. This way, you adjust the stop loss without closing the position and can follow the trend while securing profits.